Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hello everyone, I'm Ed Gotham and welcome to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Jack Schwager is back again, author of the well-renowned Market Wizards series. We're here to celebrate the launch of his latest release, Unknown Market Wizards, available now, by digging into a couple of the hugely successful traders Jack interviews in the book. You'll hear about the unicorn sniper, who hunts down high conviction trades, and the penny stock trader who now rides disruptive trends and is all about being early. Enjoy. Hello, Jack. Welcome back on the show. How have you been?
I've been fine, thanks.
This is a special podcast episode to celebrate, if you will, the release of your new book, Unknown Market Wizards. I've had a chance to have an early copy, and it's been a fun and thought-provoking read for me, highlighting some very interesting strategies. A lot of them I've never come across before. It's actually very interesting. In particular, the ones that resonated with me were related to investing and trading in themes. For some reason, that in particular, they sort of resonate with me. So what do you think sets apart the Unknown Market Wizards from everyone else? Is there anything that was different?
Yeah, so I think, even though, as you note, the strategies tend to be kind of different. And it's, usually in any Market Wizards book, the strategies of traders are different from each other. And this kind of book is no different in that respect. They're different from each other for the most part. And they're also different from strategies discussed in other books. And sometimes they're totally unique, having nothing even remotely close, like somebody like Camillo. But basically, though, when you talk about what sets them apart, a lot of those things do have some similarities. So, for example, the traders in this book, and true of Market Wizards in general, tend to be very disciplined people. They, for the most part, are traders who understand that risk management is probably more important than a methodology, and they spend a lot of attention, focus, and training, self-training, to ensure that risks are appropriately managed. One common denominator I think you'll see that does come up strikingly in this book, it comes up in other Market Wizards books as well, but I think particularly so in this book, is that many of the traders, regardless of how different they are, have strategies where where on any particular trade, they're looking to make much more than they're willing to risk. And they're looking for those points in time where they believe the market is offering an opportunity for a relatively large gain for a required risk that is much lower. That doesn't happen all the time or even often, but there are particularly points in time where whatever the trader's strategy is, applying that strategy can allow for using a relatively close protective stop or exit if it doesn't work out, relative to the gain that is possible if the call is correct. And interestingly, it's as true for traders that are purely technical as those are purely fundamental. So I could think of somebody like Brandt, who's totally technical, where he talks about specific chart points where that may be true, and people like Amrit or Daljit Dhaliwal, who are looking to pinpoint exact trades to fundamental events in which they believe the market will roar or crash and are ready to get out very quickly if they're wrong. But again, they're pinpointing very, very specific points in time.
Yeah. And is this your fifth book now?
It is the fifth, yeah. It is the fifth Market Wizards book of the standard format.
And I was just going to ask for this book, because it's slightly different to your previous books, because you've focused on known market wizards, if you like. What was your motivation for writing this one specifically? How did it differ from the motivation from others?
Yeah. So thematically, this one, actually the best contrast is probably the last one, which was Hedge Fund Market Wizards, which I did in 2012. And as the name implies, I was talking to hedge fund managers, right? This time I was trying to go exactly the opposite direction, which is finding people who do not manage money, who are not known, with one or two exceptions, not known at all, and just trade their own account and have for a long time and have done exceedingly well. So it was the concept of the unknown solo trader that is doing their own thing and nobody knows they exist, and their records are better than 99.9% of hedge fund managers, let alone traditional asset managers.
Yeah, and that is phenomenal. Why do you think that exists? Is it something to do with managing other people's money that means people take less risk, you think? Or why how do they perform better?
Well, they perform well. The idea was, I guess there is a disadvantage. Of course, there's a disadvantage to size. So, although some of these traders now, one trader's kind of built up now to own Jeff, Newman. He started out with only a few $1,000s. He's now, when I did the book, he was 50 million. He's well over that now. So it's not that they necessarily trade inconsequential amounts, but they did trade way smaller amounts. And even now, 50 or 75 million is still quite different than a few billion. So there is an advantage to, and most of these traders are even if they've made 20 million, are not trading 20 million. They may take the money and buy real estate or do whatever with it. Do other investments, and are still trading 2 or 3 million, and quite happy to double or triple that every year. So
yeah.
And I think if they were trading much larger sums of money, that would get in the way, or they would have to change their methodology. So there is definitely the advantage of being a solo trader and trading smaller sums. That's one reason why they can get these types of records, which are just kind of incomprehensible almost in some cases. But they're also exceptional traders, and the idea there is that there are people who are phenomenal traders, but they're not in the limelight. Nobody knows they exist, and they're quite content doing just their own thing.
Yeah, it's brilliant. It's amazing you've been able to find these people. It's almost like they didn't want to be found, many of them.
Yeah.
And then so I've selected a couple of people from the book just to dig into in a little bit more detail.
Sure.
The first being Amrit Sal. Is that correct?
That's correct.
Yeah, the unicorn sniper.
Yep.
Is how you've named him. And I just wanted to, on the top of it, just go into. So obviously, you've mentioned in the book one of the best performers you've ever encountered. Can you describe his trading strategy and success?
Yeah. Basically, so you get the idea of Amrit is give you a feel he's extraordinarily disciplined. He pays tremendous attention to his emotional calm and state. We'll be talking a little more about exactly mental preparation before trades. But the essence of what he's doing is specializing in event trading. And so, whenever there's a central bank announcement or some other fundamental development, most cases anticipated types of developments, but sometimes unexpected developments and being able to respond to those. So let's take the anticipated kind. Let's say there's going to be a Federal Reserve type of statement or something like that. So he will prepare, first of all, he keeps rigorous logs of all his trades going back since he started, like 13 years. And he has literally thousands of pages of notes that he's taken on his trades, what the circumstances are, what the strategy was, what worked, what didn't work. And he's able to, and he also categorizes into different types of situations. So whenever there's an event coming, he's able to draw on past analogs to that type of situation. And that, plus being very well versed on the current situation and the current market and what expectations are and so forth, he maps out essentially a game plan for whatever might happen. So if it's going to be an announcement, well, if it's this, he'll have one action. If it's that, it's another action. And for each action, if the market reacts one way, he'll know what he'll do. If it reacts another way, he'll know what he'll do. And he'll really plan this out. Puts a tremendous amount of work into these potential unicorns, because these trades don't come along that often. There aren't a ton of them in a year. So every time there's one, he does extraordinary preparation and knows exactly what he's going to do and has built up tremendous expertise in trading these events. So that's the preparation and element. And he, when let's say announcements will come out, he'll be there with his finger on the mouse, and he's ready to click the trade, whichever way, whatever the outcome is, and he knows how he's going to respond for every variation and market reaction. So that's a good part of it. Before such trades, he also spends a lot of attention to his mental state. Like I said, he will do meditation, he will do breath work. He tries to get in what he terms, and I suppose it's maybe not an original term to him. He probably picked it up from someone else, I suppose. It sounds like it is. But what he calls a deep now. And so he's very focused, relaxed, and ready. And he also does kind of mental preparation. So just like an athlete before some sort of event might think it through, and let's say a professional downhill skier in the Olympics, probably going through a slalom course, will mentally think of that in every turn and how they're going to handle it and what they're going to do. And probably a lot of professionals do this type of mental imaging. And Sal does the same thing in trading.
And it's what I find absolutely incredible about this is how he's able to achieve this, basically trading around events in a day and age where machines have taken over and they're able to react faster than humans. And typically, some hedge funds and other sort of financial institutions have access to data quicker than Amrit might do too. I mean, how is he able to do that?
Yeah, that's a great point, and it's a correct question. When he started out, we didn't have these algorithms that would be going through text and trying, and have rules for how to react to any terms and words, and could act instantaneously faster than any trader could. So earlier on, a lot of his profits did come from just being extremely quick. And even though he might miss the first part of the move, he would still be quick enough, to do very well by getting these quick initial moves to events. And as you correctly point out, now that game has changed. So now it's really a matter of not so much getting the initial pop, but being prepared how to trade right after those first few seconds. And so he can't, it's not a matter of being faster than the machines, obviously, which you can't do. It's a matter of having more expertise or preparation on how to trade the event than virtually anybody else. And that may not just be one, he may trade it initially one way, and then based on a market reaction, might trade it the other way. But he's got this, so it's really more of having planned out a strategy. I guess you could use an analogy of a chess player planning out different moves, moves ahead, depending on what the opponent does. So on each possible move the opponent might make, have planned several moves ahead. And I guess that's not an analogy that he used, but I think it would be a fair analogy.
Yeah, it's almost like he's gone one step further than that. I think you reference like athletes in the book. So it's almost like muscle memory, that he knows when this exact thing happens, he's going to react in a certain way. So it's all subconscious. It's almost like he doesn't have to think in the moment. It's all sort of done for him, which is incredible.
But it's because he's done all this preparation and he knows how he's going to react. So it really isn't pure intuition. That would be a lot easier to do if he had that type of intuition. He doesn't rely on that. He really relies on the actual physical preparation, going back through similar types of trading situations, what the market did, what his strategy was, what he had done, what he did right, what he did wrong, how he's going to trade this. So it's a lot of preparation. Now, there is intuition involved to some extent. Yeah, I think it is in Sal's interview where you talk about how he, some of these exits, which are just spectacular, and how well he exits. I forget the exact phrase, but it's something to paraphrase. He mentions like an uncanny knack for uncanny knack for picking the right spot to get out. Now that is kind of it's an intuition born of experience. But yeah, that's where so getting into the trade is a lot of preparation. Getting out a lot of times is his instincts, on how far the market's gone and how it's acting, and his past experiences subconsciously. So I think there's where the intuition probably kicks in more.
And something else that stood out is not to force marginal trades. This is actually, you mentioned this, not to force marginal trades when the market isn't offering anything, and wait until the unicorn trade shows up, which hence the unicorn sniper. In practice, that is obviously it's almost one of the hardest things to do, the art of doing nothing. How has he learned to do that? Or did you get any sort of indication on how he's refined that skill?
Well, he's learned from experience that his profits come from these what he calls unicorn trades, which the occasional trades which have great opportunity. So that those two words, unicorn sniper, and he mentions that's what he's been called by some other people, which I thought was actually to get his strategy down to two words. It's really kind of pretty good, because that's what he is. Unicorn, the word unicorn indicating that he's waiting for those isolated trades which come along once in a while, and sniper, that he has the patience not to do anything until the absolute right moment. And that patience is part of it, goes with the extreme discipline, and which is achieved because he's learned that not only do those other trades not really, they might not necessarily make any money, but the really bad thing about them are if you take one of those trades and it loses money or whatever, it's a little bit destabilizing, and it takes his eye off the ball. He should be. It's like he's a sniper waiting for the right shot, and then he's distracted by something which is not meaningful, and in the meantime he misses a shot. Right. So it's the idea that those trades not only aren't worth it, or might not even be net profitable, but that they can interfere with those trades that are really, excellent.
Yeah.
And so that's why, he knows that, and that's how, and he has the discipline, therefore, to just have that patience.
Yeah. Do you believe this sort of selective trading is important to all or most trading strategies? Sort of waiting for the trades of high conviction is something most people should follow? I mean, it's not what everyone does. Like, I think Peter Brandt, for example, has a different sort of approach to it.
Yeah. So basically, so Brandt is different. Brandt takes a lot more trades and risks very little on each trade, and is just counting on the probabilities that even though he loses on most of his trades, that his wins are 3-4 times as large as his losses, and therefore the probability lead to a gradual accretion of equity. So that's true. So that's not his approach. Although once in a while he may see a trade which is like really special, but that's not his approach. You're quite right. For other trade, so it's not everybody's approach. Some traders really will take a lot of trades and just count on probabilities. They know that their expected gain is larger than their expected loss. And by expected gain, I don't mean the percentage of times they win. I mean that the percent of times they win times times the amount they win. And that number is meaningfully larger than the percent of times they lose times what they lose on an average trade. So they count on the probabilities. So that's an approach. But a number of traders do look for those highly asymmetric trading opportunities. And even those traders who don't, the idea of when you do see a trade that looks particularly attractive for your approach, by attractive I mean in a return risk sense, then I've encountered this over and over in the Market Wizards books. Taking a much larger size trade on those trades is a good strategy. In fact, it's for some traders. It's probably a number of traders I've interviewed, but one just pops into my head immediately. Somebody like Stanley Druckenmiller, and it's a trait he kind of picked up. He probably naturally did it anyway, but in those years that he was in Soros's organization, I think he was influenced by Soros's manifestation of this trait, and that is, or as he quotes Soros, it takes courage to be a pig. So there are times where the trade opportunity seems so strong, and that the probability is so much in your favor that you don't want to trade the typical size. You want to take a larger size. Of course, those type of trades, if you're right, it means the market should go right away and continue going. And if it goes against you initially or by any meaningful amount, one should be out. So that's how the risk is controlled. But taking a larger amount on those special cases, I think, is something I've seen repeatedly and is a good strategy.
And when you're going in such massive size, obviously risk management is incredibly important. How does he manage risk when trading such size? Because one step in the wrong direction can result in massive failure.
Yeah, so Amr trades very large size relative to his, because he doesn't take these trades often. And when these trades come along, he trades really, very, very, which seemed to us recklessly large size relative to his equity. No question about it. But he is someone who has just like he will be there ready to get out in an instant, if it's not going the way he thinks it should. So he'll be very, very quick to get out. The types of trades he's taking, they should go right away in this direction, within a minute, it should go instantaneously. And if it's not, he'll be out. So that's an important part. In fact, even though he has these enormous gains, and I think I counted, there were I counted 34 days where his return on a single day was greater than 15%. 3 of those days where his return was greater than 100%. But on the flip side, he had one double digit, I think some loss in the teens or maybe 20, maybe it was even a strike, but he had one double digit loss in his entire career. And that was because his computer went down at an exact, and I tell the story in the chapter, but it's probably the most extreme case of bad luck I've ever heard of in any interview I've ever done. But that was the only case. I mean, it was just an extraordinary bad luck, and that was the only time he had a double-digit loss. So all those other times when he was wrong, he got out in a single-digit loss.
Incredible, because it must be moving so quickly in the market on those sort of things that you'd expect like a second too late would be. It probably is. A second too late probably would be the difference between a double digit and not probably.
He has no hesitation on what he should do right. It was my impression. He doesn't think, and in fact, I think a lesson he learned earlier in his career, when he was only trading a few years, and this kind of relates to it, and it stayed with him. It was clear this was an important lesson, and it also goes to these marginal trades. So he took this trade, which there was a reason to take it, but it wasn't a really strong trade. And he kind of traded too large by taking his full. He was trading for a prop firm. He took his full at that time, and he took his limit position. And then he did the same. He did trades in two other markets which were highly correlated. So basically, if his original trade was wrong, he'd either make 3 times, or he'd lose 3 times as much, or if it was right, he'd make 3 times as much. But he actually took what was effectively a triple limit size. The risk, he tells us how the risk manager came over to him and said, Hammered, what are you doing? And realized in that split second that, it didn't make any sense, and he was just hoping for this to work. He was trying to make some money back quickly or whatever. And he instantaneously got out of everything, all 3 positions. And it was a good thing, of course. But that was the only time, at least in his recollection, and that was quite a number of years ago, where his discipline lapsed, and he hadn't fully developed it anywhere near to where it is today. And there was also where he learned the lesson that you never want to hope. If you're hoping your position is right, you should get out. I mean, that was another thing. So he never hopes. He never will sit there and say, "Oh, it's going against me. Hopefully it'll go back in the next minute and I'll get out." He doesn't do that. He just gets out.
Yeah. So that old term, hope is not a strategy. And I've got a final question about Sal. He mentioned an undesirable trait of many unsuccessful traders was the desire to make a monthly paycheck. Why is that a bad mindset to have?
Yeah, that's interesting, and it's sort of counterintuitive. So when I asked him what characteristics separate winning traders, the traders that because he did work in a prop shop, he's seen a lot of traders, and even now he trades, even though he's just trading not for a prop shop, but he still trades within a group of traders. And as I've seen a lot of traders come and go, and I asked them separately what were the characteristics of those that won, and then separately with those that lost. And he said one of the main things he's noticed is that traders who ultimately bomb out are those who are trying to make money every month. So and I don't know if it wasn't him. It was another trader who worked in the same prop shop who I also interviewed. I believe it was Richard Barge, who talked about the managers who came off the floor, a floor background, and they had the psychology of you want to make a little money every day and that type of thing, which is okay if that's your approach and it works for you. But the problem with it is, for most strategies, the opportunities just aren't there every day or necessarily every month. And if you're sitting there and your main objective is to make sure every month is a gain, and if you're sitting there for a month, and worse yet, if you're depending on making money every month so you can pay your expenses, then when there's a month where there just aren't good opportunities, you'll convince yourself to take some trade which really you wouldn't normally take, and those types of trades end losing money. So instead of kind of getting closer to being profitable or losing less, you actually aggravate the loss. So the reason why striving for consistency for many traders will be a negative trait is it will entice them to take trades they really shouldn't take.
Yep.
And on this matter, let me just quote Brandt here, because I think he had a quote that I think this was Brandt's quote. He said, "The market is not an annuity." So the market isn't there to give you a certain amount of money every month. That's not how the world works.
That's a really good. That is probably some sort of fundamental thing that people, any trader, any successful one probably already knows. But it's a good one to sort of get ingrained early on. You can't force the market to make you money, basically.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Wanted to move on to the next person now, Jeffrey Newman.
Yeah.
Selected him because his story resonated with me, as I mentioned earlier. I quite like the traders in here that their strategy revolved a little bit around sort of thematic trading. Is it possible to give an overview of Jeffrey's story?
Yeah, sure. So just in short, so Jeffrey is someone who didn't really have direction. Graduated college, didn't look for a job. Thought he would try trading. In college, I think he played around with it but essentially thought when he get out of college he was going to start trading, and that's how he was going to make a living. His assumptions were kind of preposterous. His idea was to make $1 million the first year, and he planned out how much to make every day. It sort of the way he thought about it and everything else sort of contradicts just everything. Almost always people who just go in, they're going to make a lot of money in the markets. That's usually the wrong motivation. They usually fail. The idea of just making $1 million the first year. And when I say making $1 million, he started out with $2,500. So, so this was a ridiculous expectation, and he wasn't far off from meeting that. And just kept on going. This was, I think, he started out was like around 2005, roughly, maybe a year or two earlier or later. But when I did the book, he was up over 50 million. And I've been in contact with him more recently, and I think he's north of 80 at this point. So
that's astonishing.
Just extraordinary performance, and in fact, probably as good as anybody I've ever interviewed.
Yeah.
At least in terms of compounding return. And Jeffrey's one of those people. When I say, and I probably said it in the preface, that when I started this book, I kind of just assumed I was not going to find track records like some of the track records I found in the first Market Wizards book, where you had these, people like Paul Tudor Jones and Bruce Kovner and Michael Marcus, and who were putting up triple-digit returns per year. And I thought, well, yeah, they were phenomenal traders, but it was a special time. The markets were going through these big inflationary moves, so you had big opportunities, particularly for trend-oriented traders. And also, we were pre-computer power of any consequence. There were no PCs. You didn't have these big quant shops. Programming power was minuscule compared to what it is today, and so forth. So I thought that all these technological changes and the entry of quants into the business in mass, and the nature of the markets, I just thought that I would no longer see performance like those in the first book.
Yeah. And
Jeff was one of those people in this book where kind of, it was as good as anybody else in that first book, if not better. And there were some others in this book. So that was one of my surprises, actually, that it was still possible to have that type of performance even today.
Yeah. And what was incredible, I thought, as well, reading through it, is his strategies, he's sort of changed, has evolved completely over time in a few ways. And he's even made it work in penny stocks, which is unknown. Like, I don't know how many, it can't be that many people that have smashed it in penny stocks.
This is crazy. Yeah. The fact that, in fact, his early years, he was almost all, mostly in penny stocks. As he got bigger, he branched out. But even today, he likes the small, stocks under $5 or under $1 even. If he finds ones that have the opportunity. Of course, now he's too big, to trade a lot of these, or until they go somewhere, but can bring up a following. But yeah, it's kind of amazing. I always thought I no experience in penny stocks, but I kind of just assumed that penny stocks were by and large just a scam and a sucker play, and the people on the inside took money from by propagating stories, and suckers would be left holding the bag. And interestingly enough, Jeffrey, who has no inside information, has sort of kind of done extraordinarily well in those types, from his beginning in those types of stocks.
Yeah. And so, his strategy sort of revolves, and correct me if I'm wrong, but it sort of revolves around the idea that he's trying to find themes that are sort of on the cusp of breaking out and, becoming popular in areas that are innovative or new. And he tries to profit off, basically the crowd getting involved, and then jumps out on the peak of popularity. Is it the sort of, is that right? Would you say?
Yeah, exactly. In fact, I believe in the conclusion of that chapter. I have a one-word sentence at the beginning of the conclusion, and that word is early, period.
Yes.
And I write about how it struck me a couple of days after I had interviewed him. And I interviewed him, the entire day. It was like a lot of hours of interview. So it struck me afterwards that, that the key to everything he's doing and all success is he's early. He's early in spotting these trends before they become trends. He's early, and then when he gets in, his technical timing approach is such that he's getting in at the very beginning of the move. And when he's wrong, he gets out instantaneously, so it's very early in getting out. So just like two words describe, encapsulize, I should say, Ahmed Saleh, which was, the unicorn sniper. One word can encapsulize Newman, which is early. Everything he does is, and when he gets out, he's early. He's getting out at the topping during the top formation or at the very beginning of when it breaks down. So everything he does is revolves around the concept of early.
And what sort of characteristics of the stocks Newman sort of buys have? I mean, we mentioned that they're sort of relatively cheap, I suppose. Small caps nowadays, I think that's the right way to sort of describe them. And I think they tend to be, he likes breaking a breakout of a downtrend. Is that right?
Yeah, actually, let me just get it here. In my conclusion of the chapter, I try to kind of just encapsulize what, how has he done to, what are the key characteristics of the stocks he's buying. So here's kind of the list. The stock has seen a large decline or an extended sideways movement near lows. So in fact, after the interview, he took me to his, computer layout, and he's showing me some of these trades we talked about. And he showed me, and he has marked where he got in and where he got out on these computer charts. He's kind of has his own little software also to follow he creates his own little sectors, self-defined sectors. And so he has some software programs that do this stuff. So he's showing me these trades he's taken, and it's like somebody had given him the Wall Street Journal, the price, the closing prices, for the next month or year, and allowed him to place trades. It's like he knew, it's uncanny. He has these entries right near the beginning of big, these giant moves, and exits right near the top. And so it was just extraordinary that, how, where he got in and out of these trades. So the characteristics were like, so I say, a large client. So typical of the types of charts he showed me, there's a long downtrend, and then the stock starts breaking out on the upside. And so that's where he goes. But it's not just, you can get some false breakouts, so it has to be combined with some of these other factors. But that's one element of it. Or it's a very long sideways bottoming, pattern, and then it breaks out on the upside. And usually that upside, he'll see like evidence of interest, like, either volume could be a good indicator or something like that. The second thing is that the company has a service or a product that suggests considerable upside potential. And often when it's a new product, there's going to be a lot of potential hype. So it doesn't mean that the product has to be profitable for the next 20 years or anything like that. It just means that the product is such that there's a reason to believe it could get a really big move. Whether it's based on genuine need for the product or the innovation of the product, or it's based on that it's likely to generate a lot of hype, which will move the stock. But it has that characteristic. So it's something like 3D printing. So when 3D printing was just becoming a thing or just starting out, he's there early on. He's buying each of these 3D printers, trying it out. He's calling CEOs to talk to them. He's kind of doing lots of research. So he's right at the very beginning. And if he thinks it's something, then he'll pick the stock he thinks is the leader, and he'll create his own sector in that case, 3D printers, and he'll have that as a sector. And he'll probably buy some of every stock in that sector. So that's another element. Another element is there has to be a catalyst for why it's going to go now, and the catalyst could be signs of insider buying, It could be something about the product. It could be some deal, but there's a catalyst. And the catalyst will coincide then with this chart breakout. The stock is in a sector that another element is the stock is in a sector that he's defined as being primed for substantial upward price move. We talked a little bit about that already. Next, he's familiar with the product and tried it himself, as I mentioned. And then finally, the stock is showing signs of life. As I said before, either a sudden up move after an extended decline or sideways movement, or an abrupt spike in volume after a period of relative liquidity. So those are the traits of the stocks that he's buying. And by the way, he only goes long. He never goes short.
Yeah, very interesting. And just like Amrit, Jeffrey sort of it seems to have an uncanny knack of getting out of positions at exactly the right time as well. And he's like we sort of talked about, he tends to at least try to exit when a trade is at its peak of popularity. But his timing is uncanny sometimes. And there's a few stories you mentioned about, it seems to be just a bit of luck, basically, that he's been able to get the right information at the right time to come out of a lot of his positions before a lot of them collapse to, back to below where his initial position was opened, which is crazy. Like, some of these things never go on to see the sort of potential success the market thinks they'll have. How much luck do you think is involved there, or is it something else going on?
Yeah, so certainly he had, I think we had luck. I can think of two great examples in the chapter where there's luck, but it's also that he acted on it. So a lot of people can have this where he was in a position to act on. So let's take the first one. So there's a stock called Sponge Tech, which ultimately ended up being a scam. But what it was this, literally a sponge with soap in it. That was the company. And he picked up on it early because he saw this tremendous insider buying, and he didn't know anything. He just bought the stock. And then he found out more about it. He tried the product. He actually liked it. But Sponge Tech then started doing all this advertising at sports events, the tennis tournaments and football games or program. I forget exactly which one it was. And they would have their logo sort of like on the field, and that got a lot of people attracted. Meanwhile, the stock's going up tremendously, and that gets a lot of hype and following. So he bought the stock, like I think at $1 or something like that, and they would give or take. And then he always takes a few months off in the summer to go traveling, and he's in Africa, a remote area of Africa. This is pre the iPhones we have today, or he had a BlackBerry, but he didn't. There was no iPhone. The type of communication. He's in an area where it's like remote. There's no communication. But because his friend, he went into the stock, followed on his advice, is calling him, and he tells him, Sponge Tech is up to $25, and which was like crazy. It was like going through this crazy up move. So he got that call. So that's the luck, right? But instantaneously, and he tells his friend probably get out. And instantly, he goes to the office. He gets them to sort of patch him in, and he somehow manages to get the trades off, and then gets back to his tent or whatever it is, and he gets there's no phone communication, but the BlackBerries can communicate with each other apparently, which is how he explained it to me. And so he gets a message from his friend that Sponge Tech is down to $5 or something. Like literally, so he got out at I think it went as high as 28. And it went, and of course, what happened is the original founders were just getting out of the stock when there's this parabolic move, and it just kept on selling. And of course, it was worthless. So in any case, so you could say it was luck that he got out, but he had the instincts to know immediately that he had to get out. It's luck that he got that call, but he acted on it, right? A lot of people get a call and say, oh, well, I'll take care of it when I get back or whatever, So that's he had some luck, but he had the instincts to act immediately on it. Yeah.
And another, I think it was mentioned very quickly in there, and I've heard a lot of other people talk about this as well, but it's a sort of a common theory that when your sort of cousin's uncle's friend is giving them advice and about a particular trade that you might be in, and you start hearing about it, it's time to get out. Basically, when things get too popular and people that aren't even in the financial world are sort of like getting into the trades, that's when to get out. And what are your thoughts on that?
Yeah, so I mean, it generally is true. Of course, it's starting where that point is, but it is something that Jeff is attuned to. He calls it, in fact, he even calls it, I think he calls this his golf indicator.
Oh, yeah.
So when his golf buddies start talking, who are novices about investment, start talking about a particular stock or a particular thing, it's a sign. So he talks about it wasn't one of the cryptocurrencies. One of his buddies had asked him not about Bitcoin, but I think it was Litecoin or something. One of the less, one of the more esoteric cryptocurrencies, and that told him that and this was not that long before we had the what is up to now the peak in cryptocurrencies. So that's like one example. And also on SpongeTech, he was kind of attuned to this thing being vulnerable, because he talks about like being at the bar with some other buddies and they're talking about SpongeTech, probably because they've seen it advertised on these sports programs and so forth, and or seeing the stock soar. So so I think there's definitely truth in that.
Yeah,
it's the old it's a classic. I forget who said it originally, but about getting tips from the shoeshine boy. Going back in the 20s, and I think in reminiscence of a stock operator, you have those types of comments come up about people who people who have money or knowledge or talking about investing. That's always a sign.
Yeah. And another key element to his strategy is pyramiding positions, which it seems like it's love or hate relationship for a lot of traders. They either love it or they hate it. But Newman, uses it a lot. Is it possible to just go to a little bit of detail about how he does that? Because it's part of the reason why he gets such large success through the positions he gets a lot of conviction in.
Are you talking specifically about the conviction level?
So as he gets more conviction, he sort of builds his positions.
Oh, you're talking about what seems to be like pyramiding and stuff. Yeah. So basically, so he'll put on an initial position, but these stocks, he's so early in a lot of these stocks that the liquidity isn't there for him to put on, a huge position. Okay. And so he basically will, buy some every day. And as the stock starts developing more of a following and getting some hype, then the liquidity starts picking up very much, and he can enter more. So initially, it's a matter of just positioning on the very initial leg, and then later on, if he's adding to the position later on, it'll be at spots where, let's say, it might be that the market has had a move up, and then going into some other consolidation, and he's looking for a breakout, and he'll go with the breakout, But in those types of cases, even though he's adding much higher than where he got in, if the stock then, the breakouts goes back, if it's a false breakout, then he'll get right out.
Yeah.
So he'll get out as soon as he's in losing, very close to when he's in losing territory. So so even when he's adding to positions, those added positions will have very much closer protection. And so he treats them just like the initial entries. So that's why. Otherwise, if you just keep on adding as the position's going up and don't have some special way to handle that, then that's very dangerous, because then you keep on raising your position size and average price, and the first meaningful correction can turn a big gain into a net loss.
Yeah. And how does he? Because if he's built such a large position in something, it must theoretically, if there's one thing that doesn't go, like one of his themes that actually doesn't go the way he thought it would go, could be, a big risk on his account and take him back a long way. But it appears as though he still has very tight risk management.
Yeah, he's trading in concert with the liquidity that the market is providing. So originally, he might have very strong conviction that this is a big move and it's great to put on, but he can't do that because then he's too large for the market, particularly now. So not initially, but now for sure, or recent years for sure. So he's building the position in the early stage as the market liquidity provides. Otherwise, if he were to put on a huge position, he couldn't get out because he'd be the market.
Yeah.
But if he's right on these trades, when he's right, those stocks liquidity increases tremendously as they're moving up.
Yeah.
And especially when he's getting out. By the time he's getting out, there's like a lot of liquidity. So like that Sponge Tech stock had very little liquidity early on, but by the time he got out, it had tremendous liquidity. So he's able to dump this large position.
Mm-hmm. So to sum up, sort of, Jeff, are you able to sort of give us his edge in a few words?
His edge is that there's a few edges. He's very observant and very focused on catching early trends. In that respect, he's doing kind of manually in a way what Chris Camillo, another trader in the book, does. Also did manually initially, but built special software to do. But so that's one edge. Another is that he's extremely good in timing both. Well, yes, he's using charts, but of course, trend line breakouts, you can have false breakouts or a dime a dozen. But by combining them with these other indicators that the timing is correct, and then matching that with the action on the chart, he's extremely good at picking just the right spot to get in.
Yeah.
And the same thing to get out as well. I think he's got tremendous intuition. But he just also does a lot of he really does his legwork. In that sense, he's a little bit like Peter Lynch, very different. But Peter Lynch popularized the idea of trade what you know, and go to observe what's happening around you, and he does that. So I won't go into the whole story, but there's a story in the book where he latches onto the idea that cannabis is now ready to go from cannabis drinks. I should be specific here. Cannabis beverages are now ready to become a thing, and so he thinks this is going to be a new trend. So it's not just he thinks it. He goes to the biggest beverage store in his region in Texas, and he talks to the manager and so forth. So and then he goes back periodically to see how the product is moving. So it's all he really is committed to doing everything that's necessary to be correct.
Yep, his story, it really is amazing, and a lot of very interesting stories from his life in that book in trading, and definitely recommend people picking up a copy and getting to read them and go through them themselves. I just wanted to finish now, Jack, with a couple of questions more holistically about trading. The first was, do you think traders who are successful is down to some sort of innate skill, or are there other things at work?
I think it's a combination of two. It's about doing the hard work to develop a methodology that has an edge, and having the discipline to follow it, learning and executing correctly on risk management. So all of those things. But you can have people who could do all of that. They certainly won't have track records like the ones that people I interviewed. So I do believe there is another element that part of it is instinctive or innate skills. I mean, some of these people are just born. Somebody like Jeff was probably born to be a trader. Just it's sort of like take marathon running, right? You could, if you do enough preparation and training, anybody, even if you're out of shape completely to begin with, can run a marathon, even though it's very difficult to do if you're not trained properly. Impossible to do if you're not trained properly, but you can do it. But I don't care how much discipline and commitment you have. If you don't have the right body type, you are not going to run an Olympic time. It's just the people who run Olympic times. Sure, they have tremendous skill and work ethic and everything else, but they also have the right body. So there are people, no matter what they do, will never be able to run Olympic time because they don't have the right body.
And you've also mentioned before, every successful trader you've ever interviewed had a specific methodology. Good trading is the antithesis of a shoot from the hip approach. So my question here was how should people tackle developing their own trading style?
Okay, so assuming let's go back and assume this is for a relative novice, because that will include everything, even what might apply to more experienced traders. But if you're a novice, like the first thing to do is just read different books. Just pick out books that seem interesting, seem to fundamental analysis, technical analysis. Just try to see what resonates and start following the market and start kind of coming up with your own ideas and see what works and what doesn't work. And it's the first approach you come up with is not, in most cases, won't be what actually you'll stay with or what works. But there's no substitute for getting education. By education, I mean not theory so much, but just people's ideas. Not because you're going to use those ideas necessarily. You might, but those ideas may give you other ideas. So if you expose yourself to different books on trading, you'll start to develop some ideas on your own. And if you're following the market, you should start to try to come up with things. Now, once you start to come up with things, probably best thing is to initially just paper trade. Just start to get a feel for it. Now, that's not the same thing. Emotions are not going to come into play the same way. But if you can't make money paper trading, you're not going to make it trading real money. And now, once you seem to have a methodology, then you can start with a small amount of money applying it. And another thing would be to keep, like a number of the traders in this book do, log your trades. Why did you take it? Did it work? Was it a good trade? What did you do right? What did you do wrong? Start keeping a trader log like that and review it every month or so you can get rid of the mistakes you make and start to figure out what does work. So those are some of the guidelines on how you develop a methodology.
Yeah, that's really. I think it's really interesting, and I've been sort of through this myself. Is that initially you think that what strategy works for someone else, why not? It's obviously going to work for me. I can make it work for me, but actually, everyone is just different. Everyone has their own psychology, and certain things just will never work for certain people. And you have to go through the process of finding out what does resonate and what doesn't work. And something like increasing position size on trades that are going well, or you have strong conviction on, might work really well for certain people, but other people don't. It really doesn't work with how they feel comfortable. They're not comfortable trading like that. And I think that's it's something you just through experience you get.
That's absolutely true. Yeah, I totally agree with that. And the idea is, you can pick up certain ideas or types of trades that you can incorporate as part of your approach from other people. Certainly, you can pick up risk management. You can model risk management after people who are good risk managers and stuff like that. But ultimately, you have to develop your own methodology. I can't think of traders that I interviewed that they just copied somebody else's strategy that worked for them.
Well, thanks again for your time, Jack. That's been really, really interesting again, and I hope everyone else enjoyed it on listening to the show as well. Obviously, Jack, your new book, by the time this podcast that is out will be available. It's available pre-order now, but it'll be out on Amazon. Really a treasure trove of insight from some of the best in the game, and really it comes highly recommended. Definitely anyone who's interested in trading should go out and get a copy. Is there anything else you'd like to say, Jack?
No, I appreciate you're asking insightful questions and supporting the book.
Yeah. Brilliant. All right, Jack. Well, thanks very much. hopefully have the chance to interview again in the future as well.
Okay, thank you.
Cheers, Jack. Bye.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.